All right, well, let's get it back on. Welcome back to the Family Banking Podcast. I'm Chuck.
I'm John.
All right, we're glad.
Okay, guys, welcome to the show. We're here adjusting our microphones.
Yeah, well, welcome back to Episode 3 of the Family Banking Podcast.
Yeah.
With Chuck
and John.
John, co-host John.
Co-host.
The co-hoster. All right. Well,
what's the agenda today?
We're getting good views, John, on episodes 1 and 2.
Pretty legit.
Episode 2 went out today. We'll probably parse them out here a couple weeks at a time. So this is episode 3.
I like it.
And our first episode, we kind of just went over some general thinking. And, you know, it's always good to talk a little about what's going on in the economy. You know, right now with the election, we're still everybody's on tender hooks, trying to figure out what's going to happen. Stock market took a little crash. Now it's a little bit back. And people are talking about Bitcoin and gold and the dollar and, you know, all this money stuff. So it's a very, very important time. And, what we're trying to do is create a system of thinking and doing. We call it private family banking.
Right.
And it's a little different, you know. And so tonight, this episode, I wanted to talk about what is the whole banking system idea, more broadly known as the infinite banking concept, kind of created in the epiphany of Nelson R. Nash, who started this back, 25 or 30 years ago. And we'll get into a little bit about the living benefits and the death benefit, because it involves a whole life insurance policy. And then we're going to use one practical example, and that's going to be John's early experience.
Right.
At 23 years old, starting his own banking policy and buying his first piece of vacant land, and how he did that, how it turned out, and how he continues today to use that at the ripe old age of, 53. How old are you, John?
Yeah.
Well, no.
53 and counting.
53 and backwards. Anyway,
the Botox,
the Botox is working. It's working.
Yeah.
Looking great, man.
I look good.
I wish I looked that good at 53. Anyway, so like I said, today we're going to cover the banking, and there's a couple of different concepts I want to go over. One of them is living benefits, okay?
Right.
And so when we think about living benefits, well, the name's sort of implicit to what we do, and that is things you can do with this system of thought and doing while you're still alive. So what would one of those be, John?
One of the benefits of
living benefits, a living benefit.
Living benefit. You have the accelerated death benefit if you get hurt. You have the banking part of it where you can take loans against your policy. That's a living benefit.
Borrowing against your cash value is one. Yeah.
Mm-hmm.
Let me cover a couple more. So one thing some people do is they use the banking system to accelerate debt payoff. Now, a lot of my clients and prospects are not in debt. They've come from a zero debt environment, but not everybody's that way.
Yeah, that's good.
So just because you have some consumer debt, actually we can help you do what we euphemistically call a debt snowball or a debt payoff acceleration plan. Month by month, we show you what to do, how to do it, and how to use a policy. And so clarifying some terms, when we say policy, again, the private family banking system is a system of thought and doing with cash flow that acts like a banking system, because it's not a real bank, right, John?
You don't have a brick and mortar location with a teller, and
we didn't go to the federales.
Right.
We didn't go to the federal government and get licensed.
Right.
We didn't go to the state of Texas.
It's more of the principle of the idea when you call it private family banking. It's the principle of the idea is that it's a bank. You don't actually have your own location. So it's good to kind of draw that out a bit. But what kind of ways does the private family bank, what kind of ways does it actually resemble the actual brick and mortar bank that we all hold some of our money there? What are the more principles?
Well, so the question, maybe reframing that a little bit, the question is, what is banking?
What is a bank? Yeah, what is banking?
Banking's a verb. Yeah. Banking's a process. So I love this micro. I'm double mic'd here. So everybody does banking, right? Banking is nothing but putting a place to store money.
Right.
and then use it in paying bills and buying lunch and going out on a vacation and processing money through your life. Okay, so everybody does banking.
You got to have a bank unless you're stuffing it under your mattress.
Well, yeah, and then when we look at our country, there is what people call the unbanked. There are people that don't have a checking account for whatever reason.
Right.
There are a lot of unbanked people in the traditional sense of a bank, but that doesn't mean they don't do banking. You could do banking by putting money under your mattress.
Right. That would be a way of banking, I guess.
It would be a way of banking. You could put money in a jar in your pantry. The way we do banking, though, is we put it into a system where your money is secure and it's going to earn money while it's in that system. And it's going to earn it tax-free. So one of the ways in that when we talk about banking, so I'm going to kind of take this topic today. As I mentioned, we're going to talk about banking. Next episode, we're going to talk about the family part of it. What does it mean, family banking? So we're just going to strictly focus on this episode on what is banking and how does the banking methodology or system or process that we use at private family banking, how is that different and better than putting your money in a traditional bank or even a credit union?
Credit unions
and that. So let's back up and talk about the whole infinite banking concept. Where does the term infinite come from? Well, that was sort of Nelson Nash's, the originator of this concept, out of just a brain epiphany that he had one day. He was losing money in the 80s with high interest rates and realized he had all this cash value life insurance and began to take loans to bail himself out. And he said, well, wait a minute, why don't I just finance myself from here on out and not go to banks? So he figured out how to re-engineer traditional whole life policies to contain more cash value quicker, so that the average individual can actually get quite a bit of the money back right away. Now, this is a long-term philosophical savings, wealth creation, legacy wealth
protection,
and protection against early death or premature death, whatever that is. Going home to be with the Lord before you anticipate it.
Right.
We all want to live to 100, but that doesn't always happen.
Right.
And some earlier than others. So it does create sort of family backstop for carrying on if you would die, but also it creates this pool of capital that we're going to talk about. Some of those living benefits that you can have, kind of while you're waiting to die.
Right.
We're all waiting to die.
Right. Yeah. Eventually.
It's guaranteed that we're all going to die.
Right.
And so, this has a lifelong meaning, this whole idea, and it has a legacy meaning because we can pass along wealth tax-free to our beneficiaries, our heirs. Yeah. So the infinite banking concept, the word infinite came from Nelson Nash is basically saying that the ideas of how to use your own money over and over again are pretty limitless, right? I mean, you could use them to fund a business. You could use them to buy real estate. You could use them to buy gold, coins, silver, Bitcoin, stock market, property, real estate, family businesses of any kind. You could become a private lender. You could become what in real estate realm is called a hard money lender.
Right.
And some of my clients, have done a bit of that where they found somebody in need of money. They were able to probably get 2 to 3 times the amount of interest they were paying to borrow their own money from their client who they lent it to. So they might be borrowing money at 5% and selling that money, if you will, for 15%.
Right. And that principle could carry through even if you have a whole life policy. You're just utilizing the whole life policy.
Right. Well, that's the key. Right. What other financial instrument is there? If you go to your bank, the local bank, and you say, I want to make a loan against the cash in my account.
Right.
First of all, they'd probably look at you like you had a third eye. They'd go, what?
What's up?
And they're not going to charge you like current rates on policy. Cash value loans are 5%.
Right. Yeah.
And the banks today, you've not done that, but some people know if they go to the bank, it's usually going to be a premium, right? If you don't have any credit or your credit's weak, they may not even consider you.
Right. They just turn you down outright.
Yeah.
So basically, the principles of the whole life policies that we're talking about is a high cash value whole life. Why is it infinite? What you're saying it's infinite because refinement on what you said. So you learned this is that
you may want to not exercise the loan provision for things like buying a new car, because maybe you can get a 2.99% loan on a car, or a 4.99.
Yeah, if you're a real great.
Because the real goal is not to just borrow the money, but to borrow the money for the highest return, right?
Right.
In other words, you may want to save that money, and have $100,000 or whatever, or $50,000 set back, and you need a car. Well, you go out, you don't pay cash. Maybe you do use other people's money.
Yeah, use the bank's money.
Right, use the bank's money and go buy that car, because you're preserving your capital for a bigger idea, a bigger return.
Right.
Now, not everybody can do that, so I'm not saying that paying off a car or self-financing a car is a bad idea.
It's the only way to do it.
It may not be the best for some people. Right.
Yeah.
They would be better, especially if they have bigger pools of capital. If they have a couple $100,000 right now, think about it. What might happen in the real estate market? What do you think?
I think there's probably going to be some deals coming up. Yeah.
Yeah, because why?
Because of just the economy and inflation. There's definitely a lot of talk about it right now.
The prices were bloated. I mean, look at the most markets around the country, but Austin, San Antonio market here in Texas, bloated with prices way too high.
Right.
And so a lot of people are going to be underwater again, under mortgages, meaning they
can't pay out
$50,000 to $100,000 more on a property than what it's worth now.
Yeah, worth right now.
And they got a loan upwards to that amount, so they can't even sell the house for what they maybe owe.
Right.
And so that doesn't take...
That would be rough.
Yeah, that doesn't take too long to fold in on it. So.
Right.
But the people that are sitting, like, I think Warren Buffett just sold a bunch of stuff. He's sitting on the fence with cash now because he's looking for opportunities as this economy cools down maybe. And who knows what's going to happen after the election. I think bets are off right now.
Right.
But there may be some deals coming up.
Yeah.
So back to your point, it's not the only thing. So let's cover those. Let's back up for a minute and talk about whole life insurance.
Right.
Whole life insurance, it means literally what it means for your whole life. No matter what age you die, if you don't die by age 121, you're going to get all of your cash that you put into the policy and all the earnings in a check.
Right.
So if you don't die at 121, you're getting a lot of money in most cases.
Wow.
Tax-free. But most people die before that. So you have to name some beneficiaries or your heirs that would get that money tax-free.
So if you pay in for 120 years, you get all of the money plus...
Your cash value equals your death benefit.
Oh, okay.
So you get a check right then and there.
Wow. So you don't lose everything that you put in over those years. Plus you get the gains that were in the policy.
Well, for most people, after about the 6th to 8th year, you have all the money back that you put into the policy. So if you're a little older, it takes longer. But for somebody in their 20s, literally in 5 years, you can have all of your money back.
You're talking about for loanability?
No, for all your cash. Every dollar you cumulatively put in, you'll have available in cash value. So let's say you pay a premium monthly of $500 a month. That's $6,000 a year.
Right.
Let's say in 5 years, you'd have $30,000.
Right.
Paid. At the end of 5 years for some policies, depending on how they're written and what the age of the person is, and if they're male or female, by year 5, they may have $30,000 in cash value. Meaning from then on, every dollar they put in, they're getting more than they put in. And even with a monthly premium, most policies for younger people within 3 to 4 years will get every payment you make per year. Like if you paid $6,000 a year, you'll get more than $6,000 in cash value increase.
Because of the way the compounding interest is set up.
Interest and the dividends compound.
Right.
And the efficiency of the way money works.
Right.
So where in the world can you start putting in money, get a guaranteed death benefit, get guaranteed access to your money at a low interest rate, have the right to pay back the loan at the rate you want to, and earn more money on that same money while you're borrowing that money to do something else, and actually outrun the money in terms of return, and get all of your cumulative payments back within 5 to 10 years. Depending on your age, some
the way you
are
have
5
it
to
set
6
up.
years, some are 8 to 10 years. The way you set it up and your age and your health and everything else. What other system is there? There just isn't. So,
there's not one like it.
Right. And so you're using this as a platform. It's not an investment. It's a savings platform to conserve, protect, and build capital or cash for the rest of your life. So It's just very powerful concept. It does take a few years for it to really start taking off. So whole life insurance, traditional whole life, like you'll find it, some of the you have to use a mutual insurance company. You have to work with one of the people that we know. And they're the only ones that will write these kind of policies. And we guide you through it. We help design it. And we get you approved. But whole life insurance is it's permanent insurance.
Right.
Never goes away. So that contrasts that to term life. So term life is either 7, 10, 15, 20, or 30-year term, meaning for that term of time, I have a life insurance policy. Only 1.8% of people ever collect on a term insurance. In other words,
1.8?
1.8%.
Wow.
So 98% of the money is kept by the insurance company.
Right.
They never pay a death claim.
Wow.
Because most guys are going to have, or gals, and if you're a man with a family, you probably have a 20-year term policy. So you're 40. And if you don't die by the time you're 60, all those payments, although they're small, they're relatively small.
Compared to whole life.
I mean, we talked just a moment ago about putting $500 a month in. That may sound outrageous to some people, but you're getting some of that back immediately in cash value. So if you put in some of my policies, if they put in $20,000 the first year, they may have $18,000 in cash value available to them to
in 5 years.
In 1 year.
In 1 year.
In 1 year.
Gotcha.
In 1 year. Whereas in traditional whole life, it could take 8 years to get that much cash value. And you would have paid a lot more money. You wouldn't just pay $20,000. You might pay, $30,000 and wind up with $18,000 cash value, even if you got that. I haven't run a traditional model of late, but I have clients that come in with traditional whole life, and you can 1035 free tax exchange an old whole life insurance for a new banking type system policy.
Right.
A policy designed for banking, I should say.
So what you're saying is the premium payments that in year one, we're just putting out ballpark numbers. If it is $500 a month, maybe $200 of that is going to cash value, and $300 is going to maybe any insurance company because they're carrying in the beginning. But as time goes on, it actually becomes more cash value and less premium. Is that what you're saying?
Because it's growing, and
because of the compound interest.
Right.
Okay. Mm-hmm. So in theory, you're paying, even though you're paying that $500, and the $300 is still going to the insurance company, for every payment that's going in, but it's because of the compounding interest within the cash value that actually premium payment
outruns the amount of money you should be put in.
So really, if you're going to do, and obviously you can get high tech and get a chart and explain that, maybe not for this video, but you could run the analysis maybe by, like you were saying, by age. By the age of the policy, 5 years of that age of that policy, not even the age of the customer. Or the applicant, the insured, then that because of that interest accruing, it actually becomes a wash almost, or excels. Positives, yeah.
Absolutely.
Even if you do have, but the only other deal is if you had a loan against it,
there's a cost to
that loan.
That's diminishing the gain, but it doesn't outstrip.
It doesn't.
It does not run the game.
It's not.
Assuming you're paying a monthly premium and you're adding to the cash value every month.
It would be like, for example, if you don't take a loan, then there's no problem at all. It's just when you take a loan, it needs to be you need to calculate what the risk and reward is for that loan against the money.
Right, and you want to pay that loan back systematically.
Right.
Although you don't have to pay loans back, as long as you have enough cash value to absorb the accumulated or accrued interest, you don't have to pay loans back
Right, and I've done that.
That's another flexibility. You can make it up at the end of the year. I'm sorry, banking at privatefamilybanking.com.
Yeah.
That's the way to get a hold of me. Banking at privatefamilybanking.com.
Awesome. Give them a call. Give them an email. We'll see you next time.
All right.
Thanks for watching.
It's a wrap.